As we carry on exploring the various facilities offered by mutual funds, we'll be introducing you to some of the systematic plans offered as facilities by mutual funds as well. And by the time we're done with this lesson, you'll be singing the praises of each plan I cover. Let's start with systematic investment plans, more popularly known as SIPs. The way SIPs work is that instead of making you invest in a big lump sum in one go, this plan enables you to invest fixed amounts at regular intervals, say monthly, quarterly, or annually. This is a great option for small investors who don't have a lot of money to invest, and it encourages them to start investing in a disciplined manner. What's equally awesome about SIPs is how they take advantage of bear markets, meaning the times when share prices in the market keep trending downward. So when markets are down, SIPs enable you to buy more units of a fund, and when they're back up, again you just buy fewer of them. This happens because even though the NAV of the fund drops, the amount invested remains the same, thereby allowing you to purchase more units. This particular concept is called rupee cost averaging, and it essentially reduces the average cost of your purchase. Sounds exciting, doesn't it? You want to know more, don't you? Don't worry, we'll be covering SIPs in greater detail a few lessons down the line when we tackle the many ways in which to optimize wealth. For now, let's get back to those systematic plans. Let's look at the systematic transfer plan, better known as STPs. This plan allows you to invest a lump sum into one scheme and then regularly transfer a predetermined amount of money or set of units into another scheme. What's more is that if you already have a fund in place, you can also avail the STP facility, as long as the other scheme is offered by the same fund house. How's this useful, you think? Let me show you. Let's say you have 6 lakh rupees and you want to invest that money in an equity fund for your future. But you're still not sure whether you want to invest it all at once. So what you could do is just put it all in a liquid fund and then choose the STP option, which systematically transfers the amount mentioned by you into the fund of your choice at an interval which is comfortable for you. One advantage of using this method is that it saves you from the risk of the market crashing. In other words, it's basically taking care of the market timing risk. Now, in the example I mentioned before, what you could possibly do is opt for an STP on the date chosen by you, which would also allow you to transfer 50,000 rupees every month from a liquid fund to another fund of your choice for 12 months. This would help you spread the risk over a period of time instead of taking the risk all at once. And that's not the only way in which the STP proves to be useful. You see, not only do STPs allow you to transfer from one scheme to another, they also allow you to transfer from one asset class to another. Again, as long as you're transferring to the same fund house. Let's say you've invested in a portfolio where you've allocated 60% to equity investments and 40% to debt investments. Let's imagine the debt market outperforms equity. And as a result, your asset allocation changes to 50% each instead of the original 60-40. Now, had you opted for an STP, you would have been able to transfer money from your debt investments to your equity investments, where the market went down so as to reset your portfolio to its original allocation. I know. You want me to tell you more about STPs, and I promise you, I will. But I'll do that a few lessons down the line when we talk about how to optimize wealth. In our next lesson, we'll be tackling the different modes of investment. See you there.